All right, sorry I had to work out the recording. This webinar is being recorded just so that everyone is aware. Hello and welcome to our webinar entitled Increasing Your Credit Score. This is brought to you by Northwest's Financial Wellness Series. My name is Denise Kitchen, your host, and I am one of the relationship managers for the company partnership program. Our department manages the partnerships the credit union has with organizations so that they can offer credit union membership as part of their benefits package to their employees, members, and volunteers. So first off, again, thank you so much for logging in and for your interest in our webinar today. We really appreciate that. Secondly, I'd like to go over some housekeeping items. Everyone is muted due to the number of participants. And we ask that you hold your questions until the end of the presentation, so after Amy is done, and then ask them via the chat feature, which you will find on the bottom right of your screen. For any questions that we don't get to address during the Q&A, I will put my email address on the screen after everything, and you can feel free to email me and I will get the answers for you. All right, I pride myself in being very responsive, so please feel free to email me and let me know what your questions are. Also, at the very end, so please make sure that you stay tuned until after the Q&A session, we will do a raffle for a $25 Visa gift card. So please stay tuned once again until the very end of our session today. And now, without further ado, I would like to introduce Amy Cardona, my friend of Equifax. Amy, please go ahead and take us away.
Thank you, Denise. I really appreciate being included today and, able to help with this. I know credit scores are a really big deal to everybody, so I want to make sure everyone is comfortable with this as they go forward. So first thing is we're just going to go over the basics of what a credit score is. It's a number that's related to your credit history. In general, if your score is high, it's considered good. If it's low, it's bad. The data on your credit file is what feeds the score. The score cannot be calculated on its own. It takes a credit file to create it. So the key to improving your credit score is just monitor your credit file, because if you're doing what you're supposed to do, and we'll go over what that really means, the score will go up. So it all comes from your actual credit file itself. Now, how it works is that each lender reports data to different credit bureaus. There's three main ones, which are Experian, TransUnion, and Equifax. I work with Equifax. So each of us has a different, it's all based on either FICO or Vantage score, normally are the two big ones. We'll talk more about those later. But the lenders report to whichever bureaus they choose to. They're not legally required to report to all three. So a lot of lenders will report to one or two. So that's why you might see differences between one score or a different one. The other thing to keep in mind is you can pull a credit file on your own. You can use annualcreditreport.com. You can get it through a variety of apps. You can get it through like Equifax. You can go to the Equifax website and set up an account, and you can review your credit report on a regular basis. When you look at your own credit file, it's a soft pull, and you get to see everything on there. There's extra details that are shared with you as the owner of the credit file. So for instance, if I'm type 1 diabetic, I have been since I was little. If I have a huge issue with my diabetes and I end up with a medical collection that's, several $1,000s, I will see on my credit file the name of who the collection is with. And the lenders will just see a truncated version. They only see that it's a medical collection. They don't know what it's related to. They don't have that information. They just see that there's a collection, the dollar amount, and that it's medical. Because the HIPAA, that information is not shared with anyone other than you. So don't assume that what you see on your credit file is exactly what lenders see, because there are differences there. The other thing that you will see on your credit file when you pull it yourself is something called soft pulls. So if you decide to go online to see what you qualify for, and it says it won't hurt your FICO score or won't hurt your credit score, that's what we consider a soft pull. Those can be done for a variety of reasons, whether it's pre-screens, account review, that type of thing. You can see those soft pulls, but lenders don't see them at all. It's only shown to you. Lenders can only see when you sign and give approval to have your credit file pulled for an application. Or if they're doing an account review, they're allowed to do a soft pull, but they won't see it. They won't see that inquiry post. Only you will see it. That's where the difference is. So it's not that they can't run them. It's just that they can't see it hit your credit file. There are a variety of scores, and we'll go through the list of them later. So when you apply for a loan with a credit union, each credit union might use a slightly different score version. And it could be that they're using a different bureau, or it could be that it's just a different model. So there's a lot that goes on out there. The range is generally from 300, which is the lowest it'll go, to 850. I say lowest, that's for the base score model. There's also industry specifics when we look at the scores next, and that range goes from 250 to 900. For loans, at other than like specific ones like auto, credit card, most lenders use the base score model rather than the industry specific. So that 300 to 850 is the general range that you should keep in mind when you do it. If you pull it yourself, you get that base range. Now, as I mentioned, there are a variety of models. So, and each bureau offers slightly different models. So for Equifax, we have FICO 5, FICO 8, FICO 9, FICO 10. 10 also has FICO 10T, which uses trended data. Now, within each of those models, I mentioned that slightly different score range. There's also FICO 5 auto, FICO 5 bank card, FICO 5 mortgage. 8, 9, and 10 have those same industry specifics. So that's where the first set of versions, the 8, 9, 5, 8, 9, 10, that's got the 300 to 850. The industry, the auto, bank card, and mortgage, those go 250 to 900. So there's a ton of information out there, and you get your credit score, but it's really key that when you look at something that gives you your credit score, you look at the fine print to see which score model it is, because it could be that, the lender is using a different bureau than what your app is using or where you pulled it. It could be that they're using a different score model. So anytime the score comes out, it's based on the math problem that's behind the scenes. And every time a new model comes out, it's different. They're looking for improvements. They're looking for it to work better. So the score is not going to be the exact same as what the previous one was. And I promise if you look at FICO 5 versus FICO 10, there's a night and day, but there were decades between the two coming out. So that has a huge impact. Insight score is a score that there's a few different scores that Equifax has come out to try to help with different things. For example, I've got, there's an insight score for auto that some auto lenders, instead of using FICO, they're just using that score. There's also an insight score for personal loans. There's one for bank card to help with opening bank accounts. Vantage score is the most common one that you would have heard of aside from FICO. If you look at an app and it says your credit score is, and it gives a number that's in that 300 to 850 range, it's normally Vantage score. It is being seen more and more now. And it's just come a long way since it's come out. It was created by the 3 credit bureaus together. The last piece is it mentions Ignite configurable scores. That's not as commonly used. I just put that on there so that people know lenders can make their own score. So even if you have an app or you have information that you know what your current FICO score is, if the lender that you're applying with uses their own score that they created themselves, there's no way FICO or Vantage even is going to match it. So it's really important that when you apply for loans, you talk to that lender to find out which FICO model they're using or which Vantage model they're using. So that way you know that when you look at your app or you look at your information, you're matching kind of up what they're doing. The key though is that the credit file feeds the score. So it doesn't matter what the math problem is behind the scenes. As long as the information on your credit file is correct, the score is going to be correct. Now there are ranges. Like I said, 300 to 850 is the broad. 300 to 579 is generally seen as poor. 500 to 669 is fair. So as you go up, it gets better and better. That might not seem like a big deal, but what happens is lenders use something called risk-based pricing. And I'm not going to go into a ton of detail on that, but the less risky you are, the better rates you get. So if I've got, or actually better, if Denise has a credit score of like 825, she's going to get the best rate that the lender has to offer. So Northwest will give her a great deal, even if she doesn't work there. And then they'll also give her a higher dollar amount because she's not risky. She's in that exceptional range of 800 to 850. If my score is somewhere like around 680, I'm in that good range. So I'm in that 679 to 730. So I'll still get the loan most likely. Not definitely, because it depends on where I am in that range. But I have a better chance of getting a loan than maybe someone down in the 300 or 400s. but my rate will be higher, which means I'll pay more for each monthly payment. Even if we both get a $5,000 loan, my monthly payments will be higher than hers because I'm riskier than she is because my score is lower. I'm more likely to not make the payment. If I'm even lower than that, if I'm in that 350 to 400, in that 300 to 579 range, I'm most likely not going to get the loan. And honestly, the 580 to 669, that tends to be a little bit riskier as well. So I don't know what Northwest credit tiers are or what they approve, what they don't approve. When you're applying for a loan, it's important for you to review your score ahead of time, review your credit file, make everything's correct. And then if you're a member of Northwest, they have a financial coaching team. Talk to them. Have them look at you because they can do a soft pull and look at your score, see where you stand, or you can show them what you have. And they can either work through what they think you might qualify for or make recommendations on what you should do to get your score up before you apply for a loan. That way it makes it a better process overall, whether it's trying to buy a house, trying to buy a car, whatever it is you're looking to do, it's important you do the work on the front end to make it a better experience through the loan process. Like I said, the credit file feeds the score. Absolute end of story. The data on there is what makes the score happen. So it's really important that you pay attention to what's on there because you can see what delinquencies are on there. You can see if things are on there that shouldn't be on there. Sometimes, mistakes happen. Or fraud could have happened. If my identity got stolen and all of a sudden I've got charge cards that have thousands of dollars on them that I've never paid because I don't know, I didn't apply for them. I can dispute those and say it's not really me, but I don't know it's not mine unless I look at it, right? So it's really important that you actually monitor and pay attention to that. And if you see something wrong, you can go to each credit bureau and put what they call a dispute in to say this wasn't me, I didn't apply for it, and they'll work with that lender to get that corrected. And if they, if you're able to prove it really isn't you, it'll get taken off your credit file as if it was never there, so you won't be held accountable for that debt or for any delinquency, anything related to it. Now, why? What's the big deal? I keep talking about credit score and what's the big deal about getting it up, as high a level as possible. The reality is anytime you apply for a loan, they look at your credit score. Now, there's different credit scores they might look at, but the reality is a score is going to be used in some way. So you need good credit to get a car loan, a home loan, even sometimes jobs. If you apply to work at if Northwest was hiring, you applied to work for them, there's a good chance they would do what's called a soft pull. So it doesn't hurt your FICO score, but they want to make sure that you're responsible with your money before they trust you with their members' money, because otherwise it increases the chance of internal fraud. So that's where employment can also be impacted by your credit score and what's on your credit file. I mentioned before that the higher your score, the better interest rate is. So, if Denise buys a car that's $50,000 and has a high credit score, she's going to get a more affordable payment each month. So it'll be easier for her to get that $50,000 car. If my score's low, my payment will be more because my interest rate is higher. So in the long run, I'm going to pay more each month. I'm going to pay more in the long run. But again, it's because I'm a higher risk. So the less risky you show yourself to be, if you make your payments on time and do what you're supposed to do, the better terms that you get throughout the life of the loan. And it's not just a credit union thing. This is done across all lenders. They all use the scores to determine how reliable you will be on making your payments. So it's important that you do your due diligence to take care of your credit history. And if you hit a bump, it's okay. We'll talk about it later, how to get through that. It gets better if you improve over time, so that you can talk through that piece that you've made changes or you got a new job or whatever it is that hit the bump in the road for you. Now, there are 5 main things that FICO looks at when the score model comes out: your payment history, and do you pay your bills on time? That's 35% of your score. And then how much do you owe, especially on credit cards? So if your credit limit's $5,000 and you're at $5,000, it's maxed out all the time, that those two together are 65% of your score. It's over half of your score, determines by whether you pay your bills on time and how much debt you have under you. Now, your credit history is, so how long have you had credit, is 15% of your score. It's not your age. It's how long the age of the oldest trade line or the oldest account on your credit file. Great example is me when I was in college. My dad had I think it was an American Express card, and it was cheaper for me to fly. I want to say it was Continental, but when I flew to Florida where I was going to college, I used his American Express card. Well, rather than me have to, fly and charge on something under his name, he put me on as an authorized user. Because I was an authorized user on his credit card, it appeared as an account on my credit file. So my age of my credit file or my credit history was older than I was. So that's where if you have children, and you've got a credit card that you've taken care of for a long time, a really easy way to help them build their credit score is to add them as an authorized user. The thing to keep in mind is that lenders know that you have access to the card, but no financial responsibility. So you need to balance those authorized user accounts with other accounts. But again, we'll talk about that more later. The new credit piece, anytime you apply for, you sign and give permission to apply for a loan, a credit card, house, whatever it is you're trying to buy, that application has a 10% impact. It's not 10% of your score. So if I have an 825, I'm not going to get hit by 82 points. It's just 10% of the math problem, basically. And then the type of credit is 10% of the score. That means they want to see a variety of credit types on there. They want to see that you have a mortgage. They want to see that you have an auto loan. Or installment loan. Doesn't have to be auto, any kind of installment loan. They want to see that you have revolving or credit card accounts. The reality is that as how you handle each one varies. If I have an auto loan and I pay the minimum payment on it for each month, if it's a 5-year auto loan, I'm going to pay it off in 5 years. If I have a credit card and I pay the minimum balance for zero for 5 years, I'm never going to pay it off. So it's each type of a loan or credit is handled differently. So they want to see that you can handle all of them to have a high score. I did see a question about whether it's good to close out zero balance accounts. It depends on the card. If you have used it responsibly and you've been good with it for years, and so it's seen as a positive account because you've never been delinquent on it, it keeps that length of credit history on your file. So it keeps it as a positive. The thing to keep in mind is that you have to use it though. If I've got a credit card that I got when I was in college, if I buy pizza with it once a month or I get gas with it, once a month, I'll charge it, pay it off that night because the interest rate might not be great, but at least it's used. So it'll update my credit file to show it's still being used. That way the credit card issuer doesn't cut it off and it still is counted towards my credit score. If you're not using it, you have no interest in ever using it again, especially like retail cards, like a Home Depot, Lowe's, something like that, or Kohl's. If you're not going to use it, go ahead and shut it down because it looks better if you close the credit card as opposed to the lender closing it. Because if the lender shuts the card down on you, it looks like you got yourself in trouble, even if it's just that it was a zero balance and unused for a certain period of time. Now, everyone's here today to find out how to improve their credit. The key is that it takes time. It's not something you can, snap your fingers and fix. Paying everything off does not fix your credit score. The delinquency will still be on there and it can still cause other issues. The true key to improving your credit is pay your bills by the due date and try to keep your credit balances low. So if you can, if your credit cards, we all have rough months or times that things hit that you have to use a credit card to cover whatever unplanned expense. So if I max out my credit card this month, the most important to fix my score is for me to pay it down over time and to do my diligence to get it back down to where it's at what they consider a reasonable level. So that's why I just, lower the amount that you owe, especially on credit cards. So pay those down, get them to usually, some people say 50% of your max. Most lenders now say 30%. So watch what that credit limit is and try to keep the actual balance down. The other thing to keep in mind is that the day your payment is due is not necessarily the day that they report. So credit cards report and most lenders report once a month. Excuse me. So if my payment is due on June 15th and I have a credit card with Northwest, but they report today on the 12th, that payment's not, last month's payment will be reflected today. This month's payment will be reflected next month because I missed that date. So if I know there's a couple days, if I watch my credit file and see, that the payment I just made is being missed by a couple days, if I back it up and I pay Northwest on the 11th, all of a sudden that monthly payment goes through at the same time as their reporting does. So I'm not ever late because I'm paying ahead of the due date. But B, it hits before the reporting does, so it shows a lower balance when my credit file is pulled. You don't have to monitor your credit to find that out. You can ask your lender. So if you work with Northwest, reach out to Denise, ask them what day of the month does Northwest report. So if she says they report on the 5th and you get paid on the 1st, go ahead and make the payment on the 1st. That way it's done. So it's ahead, it's easy. Just as long as it's before the 5th, that payment will reflect in this month's credit file reporting, which makes your score go up a little bit faster because that debt levels down a little bit. The other piece is don't get new credit cards if you don't need them. Because every time you apply for a credit card, your score goes down by that 10% we talked about. If you're shopping for auto loans and mortgages, that's a little bit different. You have 30 days to shop, so you can have as many inquiries between those two as possible as you need to get the right loan you want. Lenders expect you to shop for those. You want a good rate. A mortgage is a huge long-term loan. It's a big commitment. It's a lot of money. In auto loans, just based on the way the auto market works, your credit file gets pulled several times with each auto application. But the key is to keep yourself within that 30-day shopping window for those two. Credit cards, every time you apply, it hits your score. So if you don't need it, don't apply for it. It's not going to help you by having it just to have the card that you're not using. So only get what you need from a credit card perspective. Now, I know the question came up earlier. Don't necessarily close older cards. Because that longer time, it'll help your credit rating. But if it's a card that you will never again use, it's better for you to close it rather than have the lender close it. So just I know it's kind of a mixed message coming out. But if it's like a Visa or MasterCard, something you can use on just daily purchases, then it's usually a good idea to keep it open, just use it periodically but pay it quickly. So that way it shows that you're using it. If it's a department store card that you're not really going to use and they're going to shut it down anyways, then go ahead and be the one to proactively close it. Now, after you've done these things for a while, so you've paid everything on time, you try to get ahead of your credit limit on your credit cards, give it 6 to 9 months and then recheck your score. You should see an increase. It'll be better. And when you check, you get the free reports from each bureau. Check each bureau. Don't just pick one and check that one. Because if Northwest works with me through Equifax, you may go down the street to another lender, which Denise, they would never do. They're just going to go with Northwest. But someone else could pull TransUnion or they could pull Experian. So you want to make sure all 3 bureaus that the data is correct and that it's clean. Now, the other thing you can do is if something happens, I mean, we all learned this during COVID. It was a really rough time. The rules learned back then don't change. So if you're having issues, call the lenders that you're working with. I've had to do it in the past and it is humbling, but they want to work with you. They don't want to shut the loan down. They don't want to get you in trouble. So I know a lot of the credit unions that I work with, they offer skip pay options. So if something happens this month, a couple of years ago, I had knee surgery. So if I'm having knee surgery and I'm out of work for 3 weeks, I can let Northwest know that, and maybe they'll give me a skip pay so that the month that I have no income coming in because of surgery, then the next month my payments resume as normal. So call them so you can talk through those options. I can't guarantee every lender is going to offer a skip pay option. They're going to offer certain things, but they don't know unless you call them. And if you just don't pay, you're going to end up in a collection situation where they're going to be reporting negatively to the credit bureaus, and their collections team will start calling you, asking you about payments. The other thing is, if you don't want to just totally skip a month, you can ask them just to reduce the payment amount, because maybe it's easier for me to reduce my payment amount for all of my loans versus just skipping 1 or 2. If you're renting, you can't do that, unfortunately, but for other types of debt, loans and credit cards, a lot of times if you work with a lender, they'll do what they can to make it easy. They want you to pay. They want you to be a member or a customer of theirs. So just be honest with them and give them a chance to work through things with you. Now, there are some quick options to increase your credit score. Now, last year, something came out from the government, Any medical collections that were less than $500 had to be completely taken off the credit file. So those are gone. If you owe a doctor $50 from a copay 2 years ago, that collection should no longer be on your credit file. If it is still on your credit file, then dispute it, because legally it should not be there. If it's over $500, it will still be on your credit file. Reach out to them and either negotiate a payment plan, see if they can write some of it off, because I know a lot of the hospitals that I work with, they have income-driven payment plans. So if you show you make a certain amount of money, and I don't know what the exact ranges are, but you can apply for basically like a charity option, and sometimes they'll write off part of the amount that you owe. So it reduces that collection. And if it drops below 500, it's gone off your credit file. But the key is if you can pay it off, so they reduce part, you pay whatever is left. What happens with medical collections now is that they report it one more time as paid in full, and then it disappears from your credit file as if it was never there. Normally, bad information or delinquent information, those stay on your credit file for 7 years. So that 7 years impacts your payment history for that 7. So, I'm late on a loan once for 7 years. That's going to hurt me from a payment history perspective. Collections are part of that payment history. It's shown as a big derogatory, so it has a really negative effect on your credit score. So if I take care of that medical collection, all of a sudden I'm back, scores can jump 20, 30 points just from getting medical collection if they're a big amount taken off. So that's a very great thing that the government has done for us in the past year or so to try to make things better for consumers. Now, the other thing is if you've got a credit card and you've done well with it, you've taken care of it, you've paid it on time, you've kept the balance low, you can either call them. I know my credit card, I can go in the app and I can ask for an increase in credit limit. Usually that's done as a soft pull, so it doesn't hurt my credit score. And what happens is if I go, say, from a $3,000 credit limit to a $5,000 credit limit, the amount I owe still stays the same, but my utilization goes down. So if I've got $1,000 on the card to start with, instead of it being a 30% utilization, all of a sudden I'm down to 20 or 10, so it makes it a lot better. And so by having that utilization down, it increases your score. Now, the other thing is if you can't get a credit card, if you're either starting credit for the first time, I've got a dear friend of mine who just came to this country from Morocco. She had no credit score. She had no credit report because it doesn't exist in that country. So when she got her first account, it was a secured credit card. So what she did was she reached out to a local credit union and she gave them cash. So she gave them like $500. They gave her a credit card that had a $500 limit. So then she would use the card to buy things or do whatever. And then she would just refill the card. It's almost like a gift card. But the difference is because it's a secured credit card, it counts as a trade line. It counts as an account on your credit file. And I apologize, I keep using the term trade line. A trade line is nothing more than an account on your credit file. So if you buy Visa gift cards, instead, see if you can get a secured credit card and use it the same way, because that would improve your credit. As you put money back on the card, you can use it. You can improve your credit score because it shows that you're paying your bill as agreed, you're being responsible with a credit card. And so that can help build the credit history. And it's not money that you're having to pay back after the fact. It's money that you're basically putting it up front when you plan to travel, or when you're planning to do anything. So like if I'm going overseas, it might be good for me to get a secured card, because if the card gets stolen, I'm limited in what I'm going to owe from a liability standpoint. My son is 20 years old. I recommended to him to apply for a secured card, actually with Northwest, because they've got a great program. But it's an easy way for people to start credit history when they don't have it. And you can adjust how much you put as that down payment. So if you don't have $500, see if you can do $250. If you have more, you can put $1,000. And so that way your credit limit increases based on the amount that you preload on the card to help as you go. Now, once you get the card, use it a few times each month. Only buy items that you can afford to pay, and pay it off in full is the best way to do things, especially if it's a secured card, because you're going to have to, if I put $500 down to the secured card, as I work that prepaid balance down to zero, I can't use the card anymore. So it doesn't really help me anymore. So then I'd have to put another $500. It's much better for me to do $50 and then put another $50 in when I get my next paycheck, or however it works. So use them responsibly, but use them for items that you've already budgeted to buy. And that way it just makes life easier. So you're not using it to go on a spending spree. You're using it within your budgeted items. So that way it keeps your limit down, and just makes life better. Now the other piece is, and it's, like I said, 65% is your payment history and, do you pay on time? Do you pay on time in your balances? How much do you use it? So pay by your due date, please. Even if you're off by 2 days, what happens is if my payment's due today and I pay it tomorrow, unless there's some sort of grace period with the credit card, it's going to assess a fee. And even if there is a grace period, sometimes a fee hits. Well, then what happens is, instead of me owing $500, that was my previous credit limit, now it's $550 or $525, whatever that late fee is. And I didn't even get anything out of it. All I did was pay late. So pay the soonest you can before the bill date. When you set the card up from day one, work with the lender to see if they can give you a pay date that works with you. I've scheduled all of when I set up credit card and even auto loans, when I apply for loans, when my kids got cars, I asked the lender to try to schedule around my payroll dates because we get paid twice a month. I knew exactly when that paycheck was coming in. So then I just put it on auto deposit or auto payment. So from, my paycheck comes into my credit union and then the money immediately goes to the car loan. So it's taken care of. If you can't do something like that where it auto pays within the credit union itself, you can use your phone. You can use different, like your digital calendars. There's different technologies you can use to set up reminders. So that way you don't forget to log in and make the payment. Now, over time, just keep doing what we're talking about. You'll see a better credit history, but it does take time. Like I said before, if you hit a bump in the road, it's not great because your score is going to go down. But the more you do the things we're talking about on this webinar, over time, you'll see your score go back up. And like, it's a great example. My friend Sada, who I told you came here from Morocco, she had 0 credit score. She had no credit file, nothing. Over the past year and a half, she's worked and been very diligent about paying things on time and being responsible with her secured card. She's got like a 745 now, she told me the other day. So her score has gone up to that level in just a year and a half by being responsible. I can't guarantee that's going to happen for everybody because she had no history and you might be coming out of a negative history, but the farther you get out from the negative, the less of an impact it has. Now, you've got a ton of resources with Northwest. So Denise, I don't know if you wanted to talk about these, or I think I talked too fast this time, so I got to the slide too quickly.
So actually now our partner is GreenPath, so we actually need to change this slide out. I didn't realize that was still in there. But we have information on GreenPath, and I will send that out with the recording.
Okay, perfect. And the thing is, so it talks about calculators. Please use the calculators. Those things are amazing. What the calculators are is if you say get an extra bonus at work, or you get a gift because you graduate from high school, college, whatever. If you have extra money, you can put in the calculator, what if I take this $500 I got and I put it towards my car loan? What will that do to my credit score? Okay, that's not a great bonus. Well, what if I put it towards my credit card? So you can put it in and do different things to see what the potential impact would be to your credit score. So if that $500 is best put towards your credit card, it'll tell you to do, you'll see that using the calculator. If it's best put towards your auto loan, you'll see that. If it's all about the same because you've been so diligent with taking care of everything, then maybe you put the $500 in a CD and let the money grow for you over time. So that way, when you decide to buy your next car or you decide to buy your house, instead of it being $500, it's grown over the 6 months or a year or whatever it is in that market. So the calculators are amazing. And if you feel kind of lost when you're looking at the credit file, the counselors, they're so key. They're paid to help you and walk you through this. So please take, use of those resources, because Northwest has a great team that does these. And if you just go to their website, it's got the list of all the different credit card options they have there. So you can kind of see if you pre-pull your score through annualcreditreport.com or through, Credit Karma's got it. I know my credit card has one. There's so many different places you can get a score update. Look at those. and see what makes the most sense when you're looking at the different credit card options before you apply. So what questions does everyone have? I know Denise said she had some in the chat, so.
Yeah, so I'm still, hold on, I'm still copying them. So if you guys want to pose them in the chat, I believe I've caught up to here. So let me stop it on my screen right there before I lose track of where I am. So we have a ton of questions, so we're going to take a few. If we don't get to ask your question to Amy, then please, like I said in the beginning, just send me an email with that question. I will forward them all once I've collected them to Amy so she can see which ones she can answer. Maybe I can answer some together with GreenPath, et cetera, and some of our branch folks. But we're going to do our best today, guys. So hang in there with us, all right? So the first question I have was, how might an eviction show up on your credit? And is it possible to not have an eviction show up on your credit report? I'm assuming that depends on the landlord and whether or not they reported. But I'm not sure how they show up. Amy, can you speak to that?
So if it's from a mortgage and you get evicted, that'll show up as a foreclosure. If you're renting, it depends on whether the landlord is reporting. And then it will, the delinquency will show, because in order for them to evict you, you couldn't have paid for a while. So that delinquency will be on there. I don't know if it would go to like a charge-off status, but there's what they call, there's codes when they report data to us. So it says whether you're 30 days late, 40, 60 days late, 90 days late. There may be a code for the eviction, and that one I'm not sure of. So if you can send that to me, Denise, I can look to see if there's an exact code.
Okay.
But the key on that is whether the landlord reports data or not, because if they don't, it doesn't show.
Right.
But there are the one thing to keep in mind, there are other reports that are outside the credit file where they can search for evictions. So even if it's not on your credit report, the landlord has other resources that they can pull to see if that eviction happened.
All right, the next question was for me, and it's specifically to Northwest, so I will answer that separately, Aria, okay? Then from Kelly, how are you able to convert a secured credit card to a regular credit card, and are you ever? And the answer is no. So we cannot convert a secured card to a regular credit card. It's a separate application. It's a completely separate process and product. So you can certainly always start out with a secured card, but then you'd have to reapply for a regular card once you've increased your credit score with the secured. So that is that. And then we've got a couple questions here. My question is, how do I refute an old student loan payment delinquency? It happened during the federal student loan payback, but it is showing on my score report.
So if you have a dispute, you can either call the credit bureau that it's on. And for student loans, it's normally on all three. So it's unfortunately, you have to do it each one at a time because the databases are separate. The one thing you will only have to report once is fraud. So let me just get that out there. If your wallet's stolen, your identity is stolen, anything like that happens, you call one credit bureau, we share that with each other. Loan information we don't share with each other. So if you have a student loan, something's wrong, you can either call the credit bureau and dispute it verbally over the phone, or you can go to the website and dispute it through each credit bureau's website. If you Google it, I know Equifax, you just go to equifax.com and they've got a section, you just click dispute an error. I know I've used Credit Karma for a few years. Through Credit Karma, I can dispute loans or issues through the app itself. It walks me through it. So it just depends on what resources you're currently using. If you pulled it through annualcreditreport.com and saw it was wrong, then you can just go to that bureau's website and do it. It's usually the easiest way.
Okay, and what I can also do for you guys is I can basically include all the links to all the credit bureaus in my follow-up email to you, just so that it makes it easy for you and you can just click on it.
And Denise, there's also the FTC has a website that it talks about, they have a brochure that talks about disputing errors on your credit report.
Yeah, I have that one too.
Okay, yeah, so I would, encourage you to send that as well to them, because it's just a PDF that can be emailed over and it walks them through step by step how to handle it.
Okay, I can include that, and then I was also gonna include the annual credit report. So
perfect.
Yep. Do all of that, so you guys have all that handy. Next question, how do I refute a missed mortgage payment because of an error in electronic automatic payment? Again, it's best to contact your lender to hopefully reason with them. And if you can't, then go to the credit bureaus. Would that be your advice too, Amy?
Yeah, so anytime you dispute anything, I'd encourage you to call the lender. That way they know the dispute's coming in. It's just fastest for them to address it through the dispute process, but if something was wrong and you submitted the payment late, then it's a matter of talking to that lender directly to talk through if it was an issue with their system to get them to acknowledge that it was their problem that kept you from paying instead of you not trying to pay. So that's where the discussion with the owner of the loan would make the most sense.
Okay, then a question from Janet. Can you explain why when you pay off a large amount or the whole thing on a credit card, you have a small increase to your score, but when your amount of debt goes up on a card, it's a big drop in your score?
Because it's more about the percentage. So if, to me, what might feel like a big payment might not look like a big payment depending on how many credit cards I have. So if I've got 2 credit cards and the limit on both is, and I'm just gonna use $5,000 because that's an easy round number. If I pay $1,000 off, I still have $9,000 in debt if they're both maxed out. So to me, it feels like I've done a lot, but it's really, I'm still 90% maxed out. So that high usage has more of an impact than my $1,000 payment.
That's what I was going to mention too, is the usage, right? So you have to be careful with what you have as far as available credit and what you're using. There has to be a fine balance there. And what's the percentage that you're never supposed to go over when it comes to credit card usage?
50 is the max, but a lot of lenders say they prefer 30.
Yeah, I was going to say, I think that's what we're told to explain is 30% usage is better. All right, if an exceptional score is gradually declining because of no installment loans, would it be worthwhile to take out a small loan to raise the score again?
It wouldn't hurt, but it depends on what you consider like down. If you're still over 780, 800, getting that loan, if you don't need it, isn't really helpful. So I don't, you'd have to look and see where you are, because the reality is if you're still in that excellent range, it doesn't matter that you drop 5 points. It matters that you're in that top tier and that you're still going to get a good loan. If it's because normally if it's dropping, it's not going to just drop because no installment loans, there might be other things going on. But I'm just not a fan of taking out a loan just to take the loan out. The reality is when you take that loan out, you're going to pay interest on it. So you're going to pay the lender back more than you took out. So even if it's $1,000 loan, yes, you've got an installment loan on your credit file, but if you pay back $1,100, that's $100 that you did just to increase your score by a few points. And I don't know that it's really worth it in the long run. So you just have to look at your credit situation one by one. And that's where the Green Path credit counselors would be a good resource just to kind of talk through them, because they can look at it to see if maybe it's more than just no installment loans that's causing it to go down. And I believe that's a free resource, isn't it, Denise?
Yes, it is.
Yeah,
So yeah, that definitely want to mention that again. Your free credit counseling resource within Northwest is Green Path. And like I said, I will include that in the email as well. And they offer, aside from credit counseling, a lot of different webinars like this as well with more information. So they're an excellent resource. Another question I received was, what if you do not have enough money to pay your minimum amount? Is there any way that a bank can provide a loan for a first-time business owner? So that is tricky, because a lot of people don't know that business loans are also based on personal credit of the owner. So the business doesn't stand alone as a business entity, right? So in other words, we never lend to the business. The owner is always a guarantor unless it's a nonprofit. So that's how that works with business lending.
It does, but they also look at the business too.
Yeah.
So they do have
2 years.
Yeah. So commercial loans, there's a lot more to them than consumer loans. They do absolutely review your account. They review your credit file as a guarantor. But there's also a ton of financial statements you have to provide for the business and other things. There's a lot that goes into getting that commercial loan to try to get the business up and running. But that's, again, something I would talk to counselors, the credit counselors, and just say, and tell them that you might sign on as a guarantor for a commercial loan, and ask them if they think you've got the credit to support that loan, because a lot of times the commercial loans are much bigger than the personal loans. And it's a lot. It's a totally different process than applying for just a car or for a personal loan.
It is completely. I will not pretend to know the process, but I do know we usually require for business to be in business for 2 years, and then the credit of the business owner is also considered.
Yep.
If there is an error or credit on the credit report, is it best to dispute it with the business collection agency or the credit reporting agency, or both?
I would do both. So call the company to let them know that you see an error. Generally, they'll tell you to dispute it online because it's quicker for them. If I go online and I put a dispute, they get a notification and they go into a portal and they can fix it if it's wrong. If they have to manually fix it, it's a lot tougher because there's a lot of details that have to go in there. And if they miss one thing or they get something off, the fix doesn't go through. And then you're back to complaining about it again. So it's easiest for you to dispute it, but call them, tell them you're disputing it, tell them why you're disputing it, because then they can address it as quickly as possible. So I would definitely recommend both.
Yeah, for sure. And my first course of action whenever you get in trouble, like Amy said previously, is always get in touch with your lender. Don't bypass that step, because they need to be aware of what's going on, and they'll be more likely to work with you, right? If they know what situations you're facing. I was unable to pay a card and it went to collections. Would it be best to pay the collection agency monthly, or wait until I have a larger sum of money and settle to negotiate a lesser payoff?
If you make the payment monthly, the collection balance will go down.
Yeah.
And collections are a big part of that payment history grid. So like I said, the first two were 65% of your score. You're going to have a huge negative there because of the item that's in collections. So I would recommend paying it down, but again, talk to the GreenPath people too, because sometimes they can help you negotiate with the collection agency, because you might not even have to wait till you have a huge amount of money. I've had people I've worked with that contacted the collection agency and said, look, I want to pay this off. I can't afford the full thing. And they'll offer them a discounted payment. It's just a matter of whether they'll give you a payment plan with a discounted payment or what they'll do. So again, that's where calling that collection agency, they want the money. Do you know what I mean? So they'll work with you to get it paid. So it's better for you to be proactive and reach out to them and showing you're willing to work with them, because otherwise they could go to court and garnish your wages.
Mhm.
So I would rather you contact them and work out a payment plan and see if maybe they'll reduce the amount due, rather than go to court and just take money out of your paycheck and you not being able to do anything about that.
Exactly. All right, the next question is more from me about Northwest. So Robert, I will address that separately, and I will email you back. Kelly has a follow-up question. Would you recommend to close the secured card once your score has increased? Does it look bad on your credit to see a secured card, like knowing you were in a bad credit situation at some point?
Not everybody, I mean, everyone starts credit at some point. Like I said, my friend Sada, she started with a secured card. She still has that secured card and her score's up to a 745. So she's added other things since then. She's now gotten an auto loan because she recently had a baby and so now they had to buy a minivan. But it hasn't hurt her to have it. You just have to be responsible with it. The fact that it's secured isn't as positive as if it was a regular credit card, but as long as you shows as paid as agreed for the time you've had it, it's not a negative.
That's what I was gonna say, yeah. When your mortgage is transferred to a new company, but your error appeared on an old loan company, which one do I call to negotiate? So this was Chase, who had the mortgage question earlier with error in electronic automatic payment. And since then, I guess the mortgage has been sold. So it would have to go through the new one.
It
Right.
depends on how the loan is. So if the loan was sold and then bought, the company, and it shows us two separate line items on the credit file, the delinquency would be on the first one. So you'd have to go to that previous company. If it was a merger or something happened that like they just changed names or changed account numbers and it looks like the same loan the whole time, then you go to the new company. Because a lot of times, like if credit unions or banks merge, the account stays the same, but the name changes on it and the account number might change slightly, then you would definitely go to the new one. If it shows as it was transferred, sold, and then it's transferred, purchased, if the negative's down here on transferred, sold, you have to go to the company that's reporting the delinquency, because the new company can't impact that old account that was never theirs.
That's true. That makes sense. All right. Next question. What is the sweet spot above 650? Sorry, I can't speak anymore. To get a good mortgage loan, getting to 720 is not possible for me.
It depends on the mortgage lender. There's not a set. If you can't, I would work with the financial counselors and talk to mortgage lenders at Northwest. I've worked with Joe Talmadge there for years. He's great. He's got some good lenders that are under him on the mortgage team. And just ask them what the lowest they would go on a mortgage loan is.
Yeah.
If they can't accommodate what you see as being able to get to in the timeline you need to, you can try a mortgage broker. What a mortgage broker does is they'll pull your credit to see where you are, and then they send it out to a variety of lenders to try to get you a loan that's affordable and within the timeline. So a lot of people who have not as good credit scores sometimes will go through a mortgage broker as opposed to directly to, a credit union like Northwest where they're guaranteed to get the best rate, just to try to have an option of getting it. You will see multiple inquiries on your credit file because the broker pulls it and then they send it out to lenders, and each lender has to pull it from each credit bureau. But because it's a mortgage, you have that 30 days to shop. So it only counts as one hit to your credit score, even though you see a bunch of different things. So I would talk to the Northwest mortgage team to start with to kind of see what they see as possible for you and what they recommend you work on. And if it's just way out of that range and you need the house soon, then a mortgage broker is another option, but the rates might not be as good as what you'd get at Northwest.
Yeah, exactly. Yeah, Chase, I can get you in touch with one of our mortgage loan officers for sure. And through your registration, I have everyone's email address. So if I say I'm going to follow up, I have your email addresses already. Does freezing credit impact your score?
It does not. So all freezing credit does is it prevents anybody from doing a hard inquiry. So if I freeze my credit file and someone gets my information, if they apply for a loan at Northwest, it's going to Northwest won't be able to pull my credit file in. The inquiry will fail. So that it stops me from having people use my information invalidly. They can still do what we call a soft pull. So if I have, say, a credit card with Northwest and they want to do a review to see if maybe my score's gone up, if they want to give me a rate an increased limit, that score can still come through, even though it's frozen, because it's a soft pull. And I already have an account with them. I've already got a relationship with them. Freezes stop hard pulls from happening. So it protects you in cases of identity theft is what it's most normally used for.
Mm-hmm. Okay, and yes, Janet, I will be sending the link to GreenPath as well. Next question, I had a JCPenney store card that was upgraded to a MasterCard back in October 2023. I recently noticed that the store card was still showing as open with the balance from October, but had no updates since then. I filed a dispute with all three bureaus and with JCPenney. Now it shows as closed, but with the date of October 2019. Is that a big deal? Interesting.
I'm not sure. It's kind of like, I've never seen where it closed 5 years in the past, especially when it just updated now. I think the key is that it's not showing as delinquent or having a balance due when there isn't one there. So the good news is they fixed that piece, but if the date it was closed is wrong, you can dispute that piece too. It has to be fair and accurate is the rule within the government for the credit reporting. And if it's fair because it's closed, but it's inaccurate, you can dispute it and make them correct the date.
I would say if it's inaccurate, just get it fixed, right? Because you want your credit report to reflect accurate information. So, do the reports show if it's a secure card or not?
I believe it does. I believe there's a comment code that can be on there, but I'd have to. Can you send me that one as a follow-up so I can confirm?
Yep. Copy that over now. So I don't lose track of it. All right. And I would say, I mean, we're 5 minutes out. We still have to do the raffle. So I'm going to copy the rest of these questions and we'll pose them to Amy separately in an email. And then once I get a response from her, I will email you guys back. So please know, guys, we're working hard to answer all these questions for you. I think I have all of them now. Yes. All right. So now to the raffle question. So get your typing fingers ready for me. Yeah, there's my email address. Thank you, Amy. Get your typing fingers ready and your keyboards out, etc. Get ready to ask the question. And we are giving away $25 Visa gift card to the first person that answered this correctly. So let me go to the bottom of my chat so I don't miss the first question. All right. So, the first answer. So what is the range of a base credit score? We had it on a slide earlier.
I think I said it 3 or 4 times.
All right, first,
Oh,
correct
Michelle
answer.
got it.
I see
Oh, no,
Dawn.
Dawn did.
Dawn, yep.
Yeah, Dawn was,
Dawn, you are the winner of this round, and I will email you to get your address where I can send that to you along with some other goodies. So again, thank you guys so much for your time today. Thank you for logging in. I know this is always a hot topic, especially now during these times, right? If you have any more follow-up questions, please email me. My email address is listed right here. Make sure you note it down. I have the other questions that we did not get to on a separate piece of paper that I will work with Amy on getting answers to you. I hope this was informative. I hope it was worth your time. We certainly appreciate you coming on. Amy, thank you again so much. You did an awesome job. You're always so full of great information. I love it. I always learn something new with you every year. Thank you all. Have a great rest of your afternoon and take care.
yep, thank you guys.